All right, let's get right into it. Welcome to today's Explainer. I am absolutely thrilled you're joining us because we are tackling what is, without a doubt, one of the most misunderstood dynamics in the financial world right now. We're looking at a massive, glaring disconnect in the 2026 financial landscape, specifically when it comes to the 10-year U.S. Treasury. Today, we are taking a complete 180-degree turn from that mainstream narrative you hear everywhere, the one screaming that high-interest savings are good. Instead, we're going to uncover the actual, brutal math of capital preservation. Because here is the hook. The 10-year Treasury is sitting at 4.3%, but your real return is actually negative. We're going to walk through the exact math the Fed really doesn't want you to do.
Okay, let's dive into this. 4.3%. For a lot of retail investors out there, seeing the 10-year Treasury yield consolidating around 4.3% to maybe 4.45%, well, it feels like a massive win, right? And it's honestly so easy to see why. I mean, if you spent the last decade navigating the zero interest rate policy, an era where your cash earned essentially zero, this current environment feels like a generational opportunity for risk-free income. The financial content machine is out there right now, enthusiastically promoting high-interest savings as the ultimate safe haven.
But we really have to ask the hard question here. Is it actually profit? Because 4.3% interest looks amazing until you subtract one very specific number. And spoiler alert, it is not profit. The brutal truth we are going to uncover today is that these nominal yields are hiding a slow-motion wealth confiscation trap. It's this incredibly technical trap that is quietly, steadily eroding your purchasing power right beneath the surface of those flashy headlines.
So here's our roadmap for today. We're breaking this down into 6 steps. First, we'll expose the 4.3% illusion. Second, we'll do the real yield math. Third, we'll look at the Muslim pivot. Fourth, the $353 trillion debt problem. Fifth, we'll track where central banks are fleeing. And finally, step 6, how to actually escape the yield trap.
All right, let's jump straight into part 1, the 4.3% illusion, and why we're anchoring in a high-pressure regime. You see, the allure of this yield is really just a psychological artifact. Because we were anchored to near zero rates for so long, this current rate feels robust. It feels safe. But guys, we're no longer in the sluggish, low inflation environment of the 2010s. Not even close. There is a stark, almost scary contrast between the retail view and the actual macro reality. Retail investors are hyper-focused on that 4.3% coupon rate, thinking they are safely building wealth. But the reality? Data from the Federal Reserve Bank of New York's March 2026 survey of consumer expectations shows a completely different picture. 1 year ahead inflation expectations have literally surged to 3.4%. That is a 40 basis point jump in a single month. It's the largest rise in an entire year. Consumers are bracing for persistent, sticky inflation. Definitely not a neat and tidy return to the Fed's old 2% target. Which brings us nicely to part 2, the real yield math, or as I prefer to call it, the math the Fed doesn't want you to do. Now, what's really interesting here is that nominal yields do not exist in a vacuum. Let's walk through the tax-adjusted Fisher equation together and see how this breaks down your actual wealth. Step 1, we start with a recent peak nominal yield. Let's say 4.43%. Step 2, well, you have to pay taxes on that interest, obviously. So if we assume a fairly conservative 24% marginal tax bracket, your after-tax nominal income drops to about 3.36%. Step 3, now from that, we have to subtract that New York Fed inflation expectation of 3.40%. When you map this whole thing out across different tax brackets, the reality is, well, it's pretty stunning. For absolutely anyone above the 22% tax bracket, you are mathematically losing purchasing power. Your real after-tax return is negative. This absolutely proves that for middle to high income earners, a 4.3% or 4.4% Treasury yield is not an investment generating profit. It is actually a stealth wealth confiscation vehicle. Just let that negative 0.033% sink in for a second. And remember, that is a conservative estimate. That doesn't even account for state-level taxes you might owe. By locking your money up here, you are effectively paying the government for the privilege of losing your purchasing power to inflation. That is the very definition of a trap. Let's move on to part 3, the Muslim pivot. Inflation risks over employment.
So for a really long time, the whole market was just anticipating a rate-cutting cycle. Everybody wanted it. But the Fed's stance has seriously hardened. Take St. Louis Fed President Alberto Musalem, for instance. He recently stated that risks are tilted toward inflation in a low hire, low fire state. What he means is that the labor market is actually resilient enough right now, unemployment is holding steady, that the Fed does not feel any urgent need to cut rates to stimulate jobs. Instead, their primary number one enemy right now is that sticky inflation. And guys, this signals the death of the Fed put, that old comforting idea that the Fed will always rush in to lower rates and rescue bondholders. Actually, scratch that. It's more like they're perfectly fine keeping rates in a restrictive plateau for as long as it takes.
So the crucial point is, what's keeping things so hot? The Fed's hawkish hand is really being forced by a wild combination of stagflationary shocks and localized economic booms. First, we have WTI crude oil persistently sitting above $110 a barrel because geopolitical conflicts are just snarling supply lines. That energy shock, it's caused consumer gas price growth expectations to spike to a massive 9.4%. Then, over on the growth side, we're seeing an absolute explosion in AI and semiconductor capital expenditures. We're talking between $120 and $140 billion. That acts as a massive stimulus to those specific sectors. Combine all of that with unsettled tariff policies, and you get an economy running incredibly hot right against a brick supply-side wall. Let's zoom out to the global macro perspective for part 4. The $353 trillion debt problem, fiscal dominance, and crowding out.
Because the yield trap isn't just about domestic inflation and taxes, it's about sheer mind-boggling scale. According to the Institute of International Finance, global debt has climbed to a record $353 trillion. Just let that number wash over you. $353 trillion. To put that into perspective, that represents roughly 305% of global GDP. We are living in a profoundly, historically debt-saturated global economy. And right at the center of this massive web is the United States. The U.S. has an unmatched dollar-denominated debt burden, well over $30 trillion in market value. This creates a really tricky situation called fiscal dominance. Basically, to fund a projected $1.9 trillion deficit and just to roll over old, expiring debt, the U.S. has to constantly flood the market with new treasuries. This massive borrowing constantly competes for a finite pool of global capital, which creates a crowding out effect. And what does that do? It puts sustained, relentless upward pressure on yields. Now, that upward pressure on yields introduces a terrifying concept for fixed income investors: duration risk. Remember, bond yields and bond prices move in opposite directions, like a seesaw. If that constant flood of debt issuance combined with all that sticky inflation we just talked about pushes the 10-year yield from 4.3% up toward 5%, the principal value of the bond itself will collapse. A mere 1% rise in yields can trigger a massive 7 to 9% price drop on a 10-year treasury. That principal capital loss, that is the absolute kill shot to the retail thesis. It would completely wipe out any of the interest income you thought you were safely earning. So how is the smart money handling all this? Let's check out part 5. Central banks are fleeing the smart money exodus.
And this brilliantly illustrates what's happening. When we look at the most sophisticated institutional players in the world, their declining international confidence in U.S. bonds is pretty obvious. In surveys of central bank reserve managers, the expectation that U.S. bonds will outperform other G7 economies has absolutely plummeted. We're talking a drop from 54.3% down to just 32.9% in a single year. The world's largest capital allocators are actively diversifying away from U.S. paper because they clearly see the inescapable math of a $353 trillion global debt burden. So instead of treasuries, where are they putting all that money? They are moving to hard assets. 39% of central banks surveyed plan to actively increase their gold holdings this year alone. Gold is increasingly being viewed as the ultimate non-political hedge against a debt-saturated, devaluing dollar. These massive institutions are voting with their capital, and they are very clearly voting for protection outside the U.S. fiscal regime.
This brings us to our final section, part 6, escaping the yield trap and navigating the repression era. We are fully entering what's known as the repression era. This is a period where rates are kept artificially below the true rate of inflation to slowly, quietly erode the value of sovereign debt. Notice the crystal clear divergence here. Over on the retail side, we have investors falling for the nominal siren song, aggressively chasing 4.3% paper returns just because it looks safe compared to recent history. But look at the institutional side. We have the central banks and the massive funds, the smart money, buying gold, treasury inflation-protected securities, and real, tangible assets like energy and infrastructure. They are strategically allocating their capital where it actually has operational leverage to inflation. Let's bring this all together and see how this builds to our ultimate conclusion. This very equation is the unforgiving math of 2026. A 4.3% nominal yield, minus 3.4% in expected inflation, minus your marginal taxes, leaves you at or below zero. The yield is mathematically a lie, it's bait, it's perfectly designed to capture domestic capital, to fund massive government deficits, while the negative real return is the actual trap that slowly, imperceptibly erodes your wealth over time.
So I'm going to leave you with this final critical question to chew on. Are you actually prepared to protect your purchasing power in the financial repression era? The completely safe investment of the 20th century has quietly become the primary risk of the 21st. It is incredibly important right now to reject the nominal headlines, stop blindly chasing paper yields, and really start managing your portfolio for real, tangible wealth preservation. Thank you so much for joining me for this explainer today. Keep learning, keep analyzing, and above all, keep protecting your capital. I'll catch you next time.